All right, welcome everyone. Thank you for tuning in. We'll give it a few minutes here while we get everybody connected. We have Kyle is on vacation today, so our usual host will be gone for today. And we do have the chat up. I saw a bunch of people were chatting earlier. If you'd like to throw it up on the screen, feel free. We'll get started in just a minute. Today we're going to talk about experienced investors, some of the lingo, some of the tips and tricks, some of the tools of the trade, I guess the words of the trade. So that will be our topic. And that covers my face. I'll leave it like that. Good evening, everyone tuning in. Give it just another 30 seconds or so that we can have everybody up to speed, and then we'll get started. Tomorrow, we will have part 2 of this training, which will be more actual structuring of the deal and putting together some example deals. Today, we'll talk about more of the strategies and I really wanted Jose to touch on the lingo for our team that may not be familiar with some of the terms and uh, kinds of ways of thinking that these investors have. All right, looks like we're about ready to start. Let me go ahead and take the chat off. And we'll go ahead and get started for today. Thank you, everybody, for joining us. My name is Nick Hershey. I'm the president of the Mortgage Calculator. I'm joined here with our sales manager, Jose Gonzalez, with 27 years of experience. We love to do these loan officer trainings every Tuesday and Wednesday for our team. We have over 300 licensed loan officers in 22 states. So there's a bunch of our team members on here as well as for prospective team members and anybody interested in learning these strategies and becoming a better loan officer. So we specialize here at the Mortgage Calculator on non-QM specifically, and investor DSCR loans are pretty much our flagship product. So we always want to make sure our team and anybody trying to learn about the DSCR products has a good background with the terms, the lingo, kind of the ways of thinking of an experienced investor. And hopefully, just like myself and Jose, become investors yourselves and are able to not only talk the talk but walk the walk. Right? We want to make sure we are living the kinds of things that we're advising our clients on as well. So definitely works better when you know what you're talking about and you understand these terms. But also make sure to try to practice as much of this in your daily life as possible too. We're going to be talking about underwriting deals, kind of sizing up deals, those kinds of things that these investors are doing, and they're going to be on the phone asking you these questions and kind of gauging if you know how to work in their terms, right? Engage deals like they do. So that's kind of what I've tasked Jose with. Hopefully, he can have some value for us here as far as defining what it is. But when we go in tomorrow, Jose will go into more of a deep dive of exactly how to structure the deals. And that's where he's going to have some fun. So, Jose, let's get into the presentation here. Let's talk about more of the basics and just kind of the terms. And then tomorrow, we'll get into the live rates.
Absolutely. Good evening or good afternoon, those of you that are in the West Coast on our team. Thank you for joining us for our loan officer training. Now, this is a topic very dear to our hearts because, as Nick said, we obviously work the whole spectrum of loans, but we do like to specialize with investor type products because it is a segment of the market that we feel for a lot of reasons has had the most growth potential, as you all know. Um, so it's real interesting that we're doing this right now because I just had a really interesting conversation with a real estate agent, and my knowledge of how the financing works, specifically how the DSCR loans work, and different market dynamics that give certain reassurances to the real estate agent in working with me, working with my buyer, working with me as a loan officer for this deal that she's selling. It's a nice multiple property folio there. And, they just had it fall through. Deal fell through. So now they're really, edgy. So to get in on another deal, they have to feel comfortable that the loan officer and the lender knows what they're doing and what they're talking about, because they don't want to be hung out to dry a second time, right? There's Everybody has to meet obligations, and it is the same with the experienced investors. I mean, you could almost substitute realtors for investors in a lot of the presentation we're going to do today, because you're going to be able to apply the same uh, rationale, the same logic, right? The same ethic, professionalism, adding value. Like Nick was mentioning, is Jose going to add value in the transaction? I hope so in this presentation here. So it's the same thing. So want to get into it here. Uh, Really exciting, right? So we all know investors are driving the market, right? The market is not getting driven by the person that's relocating, by the person that's getting divorced, death in the family. Those are the some of the usual reasons why somebody would be selling or buying a property right now. But that's not where all the action is. Whereas agency originations have decreased, they've been offset by the increase in the non-QM originations, in our bank statement loans, P&L, and our flagship product, the DSCR loan. Reason being that people have to be more creative with ways to obtain their end goal, their objective, right? We know what's happening with the inventory. There's low inventory for sale, so rehabbing is even more profitable, because you get it, you rehab it, and you sell it, and you do it all over again, right? So that's the whole. We want to get into that momentum, right? And we all know. I mean, the rates are going up, but we know the interest rates are going up. But we know that the rents are also increasing, and probably at a faster rate than interest rates. I mean, just ask anyone who who's looking for a rental property, and they'll just be griping about the issues they're having. But for our investors, they're going to look at the deal. They're going to see what their rate of return is on their investment based on how it cash flows. And on top of that, if they can make some equity appreciation, even better. But the fact that those rents are going up, have totally offset whatever rise in interest rates may have affected the DSCR loans. It really has not affected them, because again, the rental rates have gone up. It's not the same relationship that has been happening with primary and second home buyers. Not worried about rental rates, they're worried about their monthly payment. So
Yeah, their salaries aren't increasing,
yeah,
whereas rents are increasing, right?
yeah,
So it's a totally different dynamic here.
yeah. There's a direct proportionate relationships on the DSCR and the rates, but there is an inverse relationship in the interest rates and the person who's going to be living there and having to pay that monthly payment. Rates go, so their affordability goes down as the rate goes up. But on the investment side, the DSCR, they're tracking side by side, so the investors are very happy. Likewise, as you all know, when you're working these investor deals, you really have to, you always have to have your A game, but especially because you have to see they're looking for consultants to be a valuable member of their team to help with the acquisition and possibly even with the disposition of the property. So you have to add value, because when you do delight them with your service and exceed their expectations, next thing you know, they're bringing out three, four, five, six properties more for you to do. They were just testing you with the first one. You pass the test. Next thing you know, you're getting a few more deals from them, and they're also um, re- referring you to their investment group because they all tend to, participate in investment groups, right? That's some of these groups have hundreds of thousands of members on Facebook and stuff. So they're out there, everybody looking to create synergy by collaborating, sharing ideas. I mean, there's more than enough properties to go around in the United States. There's more than enough money to lend, and we're here servicing their needs. So obviously, when dealing with the investors, what are some of their concerns, right? What are some of the things that they are going to ask you for? What's going to be part of the conversation? Like the rehabbing, right? Can we finance 100% of the rehab? And the answer is yes. However, that always depends on other factors like their experience level, to a certain point, their credit, right? But experience level, and how much is the profit on the deal, because the most important thing to sizing up any deal is going to be their experience level and the profit margin on the deal. But we definitely do offer most of our options, if they have good experience, are going to finance 100% of the rehab. Where they tend to cut back a little bit is going to be if it's a purchase, on the initial outlay of funds for the purchase. It may not be 85%, maybe it'll be 75%. Whatever it is going to be determined by their experience level and the profit margin in the deal. So that'll be really important when we cover one of the other bullet points there on the pre approval. But other things that they ask is, do I need to make any payments during the rehab? And again, that will depend on profit margin and the deal and their experience level. But theoretically, no, we can build in an interest reserve into the loan. So theoretically, they would not have to make any payments, which are interest only payments during the rehab. But like I note there, the experience level is what's going to determine that, and the profit margin and the deal. You know that I keep repeating those terms because that has to be like always in your mind when you're dealing with investors, because they may tend
That's the disclaimer at the bottom of the screen every time
yeah, right.
you're
They
answering their questions.
Because they're going really fast, and then you go, yeah, but yeah, and you gotta always qualify that response, right? It's because then they're going to ask you how much income will they need to verify. Well, we don't really need to verify any income from them, but we do need to see the profit margin in the deal. That's the income. Just like in a DSCR loan, we don't verify any personal income from the borrower. We qualify the borrower based on the rental income generated by the property. The fixed flip borrower is going to be qualified by the income generated by the deal, which is a profit. If the lender, the on this loan, doesn't feel that there's enough profit in the deal, they may feel that the our investor, our rehabber, our flipper may lose their motivation to close the deal and just walk away from it, right?
So
But
the answer to this question, I think, Jose, is how much income will you need to verify? Um, I mean, the answer is going to be how much income is going to be on the deal. So how much profit is on the deal, and most importantly, what's your exit strategy? So that's going to be hopefully in one of your other
absolutely,
bullet points
absolutely.
here, because you're not going to know what their profit is until we know what they're planning on doing. If they're planning on keeping it, it's a different story.
Yep. Oh, yeah. That's how we're going to cover that in a minute. So another thing they might ask you, one of their concerns, and remember, when they ask you these concerns, you need to have the right answer. You need to have a professional answer. You can't waver. You know, I'm not telling you to make up an answer, because it's about being honest with your answer. And if you have to find out, tell them, let me do a little bit more research on that topic. I'll get right back with you. But stuff like this here is pretty easy to answer. Like, can you pre-approve me for a fixed flip loan purchase? That one is very tricky because you can partially pre-approve them like you would do a credit and income. You're going to look at their credit. Okay, you're going to see it meets the minimum, because that's really one of the things you got to worry about, as long as you meet the minimum. But other than that, the only factor that you can gauge is their experience level. Okay, so yeah, according to your experience level and your credit on a hypothetical situation, this is where you would be. But at that point, how do we gauge the income?
How
You
do we
don't
get the
have.
profit and the
Yeah, yeah,
exit? Yeah.
yeah. What's our ARV? What's our as is value? What's our purchase price? What's our renovation cost? Do you have any soft costs? Do you have any hard costs? What do all these things that you're not going to know until there's an actual address. There's the potential to put a property on the contract. So if he's identified the exact property with the address, he wants to do that offer, but they want to know if they can do it. At that point, you can issue them a pre-approval for that specific property if they provide you with the information you need, right? And the information is going to be the information you're going to need to vet any fixed flip loan. What is the as is value? What is the purchase price? What is the renovation amount? um, to begin with, ARV after repaired value, and then you determine a profit. And based on that, they have algorithms for this and built into the system, and you put it into your pricing engine. And if it likes it, it gives you a good result. And if it doesn't, maybe not so good a result. And in some cases, maybe it's totally, we don't want it. But that's why you cannot say, sure, I'm going to pre-approve you and give you a pre-approval letter to go start shopping around town for fixed flip properties. No, I mean, it's not going to work. You can tell them, yes, your experience level will put you at a certain point when you do, and your credit and your experience level, and you could give them some examples based on profit scenarios, so they can have an idea of the percentages that they would have to put for a down payment, and the percentage of the rehab if it's not 100% that would be financed, and the interest reserve and all that kind of stuff is easy to do in the online sizers that we have for these fixed flip deals. But you do need property specific information to give a specific pre-approval, right? And then they also may be asking you, maybe they already have it already, and they're like, can I do a refinance of my fixed flip purchase? Of course. I mean, it all depends what type of a transaction we're talking about, right? The most common one that we get on this, the one that would not have any red flags, would be a delayed financing, right? Delayed financing, you bought the property cash, and now you want to recoup your cash investment. So you can set the deal up as a delayed financing refi of this property, or delay financing purchase, however you want to look at it. And then we can set the deal up like that, and they can recoup certain percentage of their money back. It's still going to be, not going to be 3% rate, but they're going to get their money back, a good portion of it, so they can buy another one. Remember, this is all about margins. This is not about, I want to get the perfect rate. It's more about how soon can you get it done? How much of the total nut can you finance for me, right? And do I have to make any payments during it? Because they want to know their flexibility, so they can keep the machine churning out deals. It's really what it boils down to. Always stay on the move. So we can do a delayed finance deal, or we can do a cash out refinance of the deal. Though, those can be a little tricky, because when somebody comes with a fixed flip and says, I want to do a cash out refi, and they didn't finish it, there has to be something going on. Hopefully, it's not a bad thing, So you might have to jump through a few more hoops of fire, but cash out refinances are possible on a fixed flip. They're just going to have to document how much they've already spent on rehab, how much they have left, and then the same after repaired value and all that kind of stuff, so that they can figure out the profit margin in the deal and see if they want to lend them the money so they can keep on their project. So, what are some of the terms that we're going to have to worry about when we are speaking with these investors, right? Well, obviously, seasoning on title is one of the things that may come into play. Seasoning on now, this all has to do with the exit strategy that we're talking about here, because every fixed flip loan needs to have an exit strategy. And the exit strategy is going to boil around, are you going to keep it or are you going to sell it? So, again, seasoning on title is going to determine what you're going to be able to do with that property as soon as you're finished with the rehab, right? If you just bought the property and it's going to take you 2 months to rehab, well, you've been on title 2 months. So we have to make sure that if you are going to keep the property, that we look for an option that is either A, has a zero seasoning requirement, 0 to 6 months, and we do have those options, or B, this is one a lot of people don't think about, but there's an exception that a lot of our investors, and here we're not talking about the flipper, but the company who we sell our loans to, there that they will give exceptions for properties that have had a high amount of renovation done to it. Typically, depending on the scope and amount of renovation, they will allow you to basically circumvent any seasoning requirements. Right. So we're not usually talking about just putting a little paint and a little fresh flooring. You got to do a little bit more extensive renovation. But if they feel that you increase the value of the property due to your extensive renovation, then there is the option to do your cash out refi based on the current market value and not purchase price plus repairs. That's really important when you're considering your exit strategy. Now, when
What
these
about rate and term, Jose? A lot of people overlook the rate and term. Remember, there's no seasoning on rate and term, right?
right, so if you are only financing the amount owed, right, and the renovation is part of the purchase loan, then that there's no cash out going to the borrower. So, on a worst case scenario, you would not have any issues with seasoning if you're not cashing any money out.
Exactly. I think a
Above
lot
and
of our MLOs forget that, right? An investor wants cash out, but the actual need is out of hard money, right? The investors need out of hard money because it ends, right? It has a date that it's no longer going to be valid. They foreclose on that date, right? So they have a date. That's their real problem. The real problem is not getting the 5,000, 10,000, 50,000, whatever they have maybe that they might be able to get out. The real problem is they need out of the loan. So dig in there, guys. That's definitely probably the real core issue rather than do they want their cash out, because always give them the no seasoning option, which might be the rate and term.
absolutely, so there's a lot of things there that we can consult our investors with. That's why we have to be, up on all of these different parameters that could affect them. So, again, cash out, you have to be concerned with seasoning on title or the extended renovations to try to get the seasoning exception, or else you go rate and term where you can recapture the full amount that was spent on the property, assuming you're going to get enough LTV. However, we know that the investors, they want to keep the machine oiled, and you don't keep that machine well oiled on rate and term refis. You gotta have some fuel to burn, and the fuel is the cash out. A lot of these investors now are gonna be asking you about recourse or non-recourse loans. So first, I will let the team know that we just got a new option on our non-QM, which offers non-QM business purpose loans that do not report to the credit bureau. So it's not a full non-recourse Because what non-recourse and recourse means is, recourse means that there's a personal guarantor who is ultimately responsible. So even if it's a loan made to an LLC, if it's a recourse loan, some natural person had to sign off on the fact that they'll pay. They'll pay if the borrower doesn't pay. They're the guarantor. Non-recourse, which is usually for like very large dollar amount commercial loans made to an entity. Non-recourse loans mean there is no personal guarantor. The option that we have for our non-QM, now we do have non-recourse commercial loans. I'm not going to say we don't, but the option that we just were made aware of that would be usable for all of these lower dollar amount DSCR loans is for a business purpose loan only, where they do not report to the credit bureau. And that's really what these savvy investors want. It's not so much about, I don't want to pay it. They have no intentions of getting foreclosed on the property. I mean, these investors are the best paying people. Their deal is they don't want to tie up their personal DTI with on because they may want to do something of a personal nature, right? And if you got 15 properties, 15 DSCR loans there, that could place an issue, right? So that's really their concern when they're asking about non-recourse versus recourse loans. So, be aware of what the phrase means and dig a little deeper when they ask them, what is your concern? Is it, being a personal guarantor, or is it having it show up on your personal credit report? They're going to love getting into that conversation with you, believe me or not.
And
They love that.
let me help a little bit with the answer too of what actually this means in real life, right? It means when the foreclosure happens on a recourse loan, they have a judgment against a person. On a non-recourse loan, they only have a judgment against the property and the LLC if there is an LLC, but most investors only have one LLC per property. So if you have a non-recourse loan, you typically are gonna, if you foreclose, you're just that LLC is gonna close, and that's the extent of it. There is no attacking their personal funds. So it really separates personal from a true business and a true LLC. So that's really what the nature of the difference is. As Jose said, they might not actually want that. They actually want the in between of not tying up their personal credit. They don't actually plan on foreclosing, as Jose said, because really the only difference is when it forecloses, right? So that's a bad thing, right? So we're never going to get to that end of it. All we're trying to do is structure it properly from the start. Nobody wants to foreclose.
Right. And to be able to have the conversation with the investor. If they ask you about recourse and non-recourse and you're a deer looking into the headlights reaction, that might not go very well after that, right? Now, the next bullet point I have on here, because it's causing a lot of confusion in the industry, is the proof of funds pre-approval letter, right? Now, we have a lot of our investors out there in the fix flip world that are getting or asking for, because in certain markets they handle things a certain way, are asking for a proof of funds pre-approval letter where they may be able to obtain a document that says that they have a proof of funds for X dollar amount, or an actual pre-approval document. Yes, Nick, California. Talking to Nick, who put up in the chat there, or a document that says from a lender or a broker that says that, yeah, you got guaranteed funds. But if you all are aware of the shortcomings that I just told you that are not possible, to the guarantees that you cannot give when pre-approving a borrower until you have property specific information, then why do you think that a borrower would be able to go driving around town with a proof of funds pre-approval letter unless the individual property is vetted? So something is not adding up there. So
AKA, it doesn't exist, guys.
yeah.
If you've seen one of those, it's probably
Yeah.
not on the up and
So
up.
someone put there in the chat, yeah, California, LOL, and yeah, the one scenario we had where they were asking for it was actually for California, and it's a little bit of a difficult situation there. Don't get sucked into that, because in the end, if it doesn't work out properly, that borrower could lose their deposit, and it could be substantial. And in some markets, I see little deposits, but in the markets where we're asking for this kind of documentation, where they probably have a lot of demand and low inventory, there's probably going to be big escrow deposits, 25, $50,000. And if they lose that money because of that letter didn't properly represent what they thought it did, they're going to come back at you as the licensee, at you and the realtor, because you're the ones with licenses, and you're the ones that they can just press the complaint button and start all sorts of dominoes falling. So that's why it's important then educate your borrower on what is and what is not possible, and govern yourselves accordingly. It may be a deal you don't want to get if it's going to end up causing you a big headache and possibly losing your license.
Let's talk about proof of funds, though, Jose. So, proof of funds is not something we deal with as loan officers, right? We don't are not involved in proof of funds. We're involved in approving a loan. So, a proof of funds is a borrower's bank statement that a borrower provides or doesn't provide to their realtor to put with an accompanying offer, right? So we're not involved in that at all. We come in after the offer gets accepted. If the proof of funds worked to get the offer accepted, great. If they didn't have to have one to get the offer accepted, great. But there is no such thing as proof of funds on our end as the lender, right? We can't produce those letters, and we don't use those letters. We simply get a purchase contract, and then we structure a loan around the purchase contract. So don't get sucked into that realtor asking you for something that they're supposed to do, and borrower asking you for something they're supposed to provide. So a lot of people could get sucked down that rabbit hole, as Jose likes to say.
Yep, don't make any representations that you're not supposed to make. Don't guarantee anything like that. I mean, the numbers are the numbers, facts are facts. So we're consultants. So very important, because we've had a couple discussions with some team members regarding the proof of funds pre-approval, and we've tried to give them some guidance on that, and how to keep your license out of trouble. So ARV stands for after repaired value. Really important note, because a lot of the deal is going to hinge on that, right? You need to have a good ARV. In the beginning, all you're going to get is just somebody's estimate of what it is. Maybe there's some realtor comps that'll provide some ARVs, but once the deal is in process, that's going to be determined by the appraisal, because you're going to order an appraisal that's going to ask for the ARV, that's going to include the amount of renovation on the deal, scope of the work, and then the appraiser, taking that into consideration, is going to look for comps that are in the end condition that the subject will be, and then you have your after repaired value. So you can reach out to your realtor partners for assistance in the ARV as well. That's a good opportunity to create new investor and realtor relationships. So ARV, you have to know what that is, or else you can't size up the deal. As is value, another important concept to be aware of. That's the current value of the property as it sits. Usually, the as is value and the purchase price will be the same, because that's just how you put it. It's
but
hard.
but not always on these fix and
Yeah.
flips, right? That's what I was
Right.
gonna say. If
Yeah.
you find a good deal, that may be a very different number, which helps you.
Yeah, and you got to be able to document all of these factors. At that point, it really depends on the condition of the property and everything. But know what the as is value is, because it's the difference from the as is value to the ARV minus the renovation, hard, soft, and soft costs. That's going to determine your profit margin, right? So your renovation budget is simply the cost to actually do, whatever work is going to get done on the property, the whole scope of the work. That's your renovation budget. You need to know that amount, or else you can't figure out the profit, right? And then you have things like soft costs and hard costs. Soft costs are stuff like architecture fees, for the cost to draw up the plans, cost of the permitting, soil compaction tests, and other engineering type tests. Anything leading up to breaking ground are soft costs. And then your hard costs are obviously everything that has to do with breaking ground and actually building the structure. Those are all your hard costs. So these are some of the terms to master. There's a few more, but remember, you have to be able to talk the lingo with these investors to gain their confidence, right? And importantly is, like Nick was mentioning, the plan here. There needs to be a plan. You can't just go into the fixed flip loan
Blindly.
without blindly
That's where we
because
come in, right? Yeah.
because it's a short term loan. It's either going to be, depending on what loan you picked, it's either going to be 3 months, 6 months, 9 months, 12 months. Usually the fixed flip is not going to be longer than 12 months, because then that would be like a pretty extensive fixed flip at that point. But you got to know what's going to happen, right? What's the deal here? What are you going to do when the dust settles, right? So in order for that, you to make a solid decision there, that's why we're talking about ARV. But you need to then make sure that your information is as updated as possible. Reach out to your realtor partners and collaborate with them for their market analysis. Remember, you're going to be referring these realtor partners deals. When you call them, hopefully they're going to think it's another deal coming. They're going to pick up your call. You're going to tell them what you need, and they're going to reply with the data that you need to assist your borrower, your flipper, because it could be a listing that this realtor is going to get to. You never know, right? But you need as accurate data as possible. I wouldn't recommend it being like Zillow or something like that. You want to reach out to a professional to give you some solid market data, so that then your investor, flipper, rehabber can let you know, are they going to hold it or are they going to sell it? And in the market analysis we're talking about is a market analysis for the rental values as well as resale value. And then obviously you'll be providing quotes to your borrower for the exit loan. If they're going to do a DSCR at the end, you'll give it to them in the beginning, and then as the deal progresses, you'll be updating your borrower with quotes so that they can be empowered, so that when it comes time soon to make that decision, they can say, you know what, Jose, man, those rents are looking so good. It would be a shame for me to sell this property with a 1.3 or 1.4 DSCR. Or conversely, they could say, you know what, I don't mind making 100 grand more profit on that deal, and let's sell it. But again, that all comes with proper planning for the exit strategy. Because if you don't have an exit strategy, you got nothing. And this is where we shine as the consultant, right? Because some of these flippers, maybe lesser experience, and you're giving them guidance, or some could be more experienced, but they still need as much data as possible. They want to be empowered, and that's the best way to be a consultant. Empower them with information so they can make a knowledgeable decision.
Awesome. So I don't see any questions here, really. Andre had a good comment. I mean, this is why we're doing the show today. Investor relationships will give you residual income. That's exactly right. That's why we want to make sure you guys can talk the lingo, because whether you structure the one deal you're talking about now, if you're a resource for these investors, right, they're doing deals 5, 10 a year, right? Most of our investors are at least trying that many, hopefully executing as many as they try, but they're always going to be, constantly sending you scenarios that you need to quote, and they'll constantly be buying and selling properties that they've already have loans for, right? So you can help them structure those exit strategies as well. Any other questions from anybody? hopefully some come up tomorrow. So tomorrow we're actually going to go into the more fun part. Okay, wait, hold on. Nick has a question here. There's a good question here. When asked to provide all their mortgages, I've gotten a lot of objections from bigger guys. Any advice on how to work through that? Well, obviously it's just part of the conversation. We don't need a copy of all the mortgages until we have a loan going, but yes, obviously we will. I like to talk to the investors about what kind of loans they do have, right? So I would like to know. I don't need to have the document to know if it's excludable, right? If it's in an LLC, if you're talking about uh, something we don't need to include, right? If that he has this investor in this case maybe has a separate LLC for all these properties, we don't need to know about all those as long as they are going to be separately excluded. We only need to know about the mortgages that are in the name of the LLC that we're talking about right now. And if we're building a new LLC for this project that we're proposing, which is typical of most investors, they have an LLC that they're going to create for this fix and flip or for this DSCR loan, I guess you might be talking about here, Nick. Um, then we just need to get the ones in their personal name because the LLC doesn't even exist yet, right? So you don't need all the mortgages. So I would be careful what you ask for there because you don't need it a lot of times for these investment loans. Now, if you're doing a agency loan, obviously you're gonna need all of them, and there's just no choice there. The only thing I would tell my borrower is, hey, it's not me, right? It's just a part of the guidelines, right? So it's never us versus the borrower, right? It's me and the borrower versus the guidelines or versus the underwriter. I don't want to ask you for mortgage statements, but it's just something we have to ask for agency loans. But for these investor loans, I think you should probably not ask for that maybe as much as you have to avoid that question altogether and more so talk about what the loans are rather than for a copy of the statement. Hopefully that helps. All right. Well, if there's no other questions, so yeah, tomorrow we're going to go into more of the fun part. Jose's actually going to structure some deals. So we'll go through, propose a fix and flip, I hope, Jose, and then we'll take it into a couple exit strategies. Obviously, the fix and flip quote will have the sell strategy, right? The ARV. What if you sell it the day it's done, right? That's if you sell it at ARV. But we'll also have Jose go through some examples of how to exit. So if we exit into a DSCR, we have options for that. We also have some options for our investors for like portfolio loans and some other more heavy investor products that I'm going to have Jose present for us here. So there will be a couple more detailed examples. Hopefully, this lingo will help as we go through and we'll get the more exciting numbers on the screen, the products on the screen, chat about that. But thank you, Jose. And thanks everybody for joining us. Tomorrow we start at 7 p.m. Eastern for part 2. It's actually called BRRRR, right? Investing strategies, which is what we're talking about here, which is buy, renovate, rent, refinance, and repeat, which is kind of the new lingo for what we just talked about. So that's actually the title tomorrow. So tune in tomorrow, 7 p.m. Eastern. And thanks everybody for tuning in. Have a good day, everybody.
Thank you, everybody.